Question 1. Which of the following statements is true regarding the tax-deferred growth feature of annuities? A. The interest earned on an annuity is taxed immediately when it is credited to the account. B. Annuity owners pay taxes on both the principal and earnings during the accumulation phase. C. Annuities provide tax-deferred growth, meaning taxes are paid only when withdrawals are made. D. Withdrawals from annuities are subject to capital gains tax regardless of the withdrawal period. Answer. C. Annuities provide tax-deferred growth, meaning taxes are paid only when withdrawals are made. Explanation. Annuities are known for their tax deferral benefits, meaning that the growth of the annuity is not taxed until withdrawals are made. This allows the investment to grow without the immediate tax burden, giving it a potential advantage over other investment vehicles. Therefore, the correct answer is C. Option is incorrect because the interest earned in an annuity is not taxed immediately during the accumulation phase. Option B is incorrect because taxes are paid on the earnings, not the principal, during the withdrawal phase, not during the accumulation phase. Option D is incorrect because withdrawals from annuities are typically taxed as ordinary income, not as capital gains, unless the annuity is held in a qualified account like an IRA. Question 2. Mr. Allen is considering purchasing an annuity to provide a stable income stream for his retirement. He is particularly concerned about the potential impact of inflation eroding the value of his income over time. Which type of annuity would best address Mr. Allen's concern? A. A fixed annuity. B. A variable annuity. C. An indexed annuity with an inflation rider. D. A deferred annuity. Answer. C. An indexed annuity with an inflation rider. Explanation. An indexed annuity offers a return based on the performance of a stock market index, but it provides a level of protection by offering a guaranteed minimum return. When paired with an inflation rider, it can help adjust the annuity payouts for inflation over time, addressing Mr. Allen's concern about inflation eroding the value of his income. Option was fixed annuity provides a stable and guaranteed income stream but does not account for inflation, which is why it would not be the best fit for Mr. Allen's needs. Option B, variable annuity, has the potential for greater returns based on the market's performance but does not have any guaranteed protection against inflation. Option D, deferred annuity, refers to an annuity where the payout starts at a later time but it doesn't address the inflation concern. Question 3, scenario-based. MS. Parker, a 60-year-old retiree, has purchased a deferred annuity with a 10-year surrender period. She has recently encountered financial hardship and needs to access her funds immediately. What should MS. Parker consider regarding the surrender charges associated with her annuity? A. There will be no surrender charges because she is over the age of 591. B. The annuity will provide a penalty-free withdrawal of up to 10% of the account balance. C. She will incur surrender charges if she withdraws funds before the end of the surrender period. D. There will be no surrender charges if she withdraws the entire balance at once. Answer. C. She will incur surrender charges if she withdraws funds before the end of the surrender period. Explanation. In a deferred annuity with a surrender period, the annuitant may face surrender charges if they withdraw funds before the agreed-upon surrender period ends. Typically, these charges are a percentage of the withdrawn amount and decrease over time. Since MS. Parker is withdrawing before the end of the surrender period, she will incur these charges unless she meets specific exceptions, such as for certain qualifying events. Option No is incorrect because the age of 591 refers to early withdrawal penalties for retirement accounts like IRAs or 401ks, but surrender charges on annuities are based on the surrender period, not the age of the annuitant. Option B is incorrect because while many annuities allow a 10% penalty-free withdrawal, this is not a universal feature in MS. Parker is still subject to the terms of her annuity contract. Option D is incorrect because withdrawing the entire balance does not automatically eliminate surrender charges unless there is a special provision in the contract which is not mentioned here. Question 4. Which of the following is a characteristic of a life with period certain annuity payout? Option A. Payments continue for the lifetime of the annuitant with no guarantee to the beneficiary. B. Payments are made for a fixed number of years, regardless of whether the annuitant is alive. C. Payments continue for the annuitant's lifetime, but if they die early, the remaining payments go to a beneficiary. D. Payments are made for the annuitant's lifetime, but they stop upon the annuitant's death. Answer. C. Payments continue for the annuitant's lifetime, but if they die early, the remaining payments go to a beneficiary. Explanation. A life with period certain annuity provides income for the annuitant's lifetime. However, if the annuitant dies before the period certain ends, for example, 10 years, the remaining payments will be made to a beneficiary for the remainder of the period. This option provides both lifetime income and some form of death benefit, ensuring that no payments are lost even if the annuitant dies prematurely. Option is incorrect because it doesn't guarantee any payments to a beneficiary in case of early death. Option B is incorrect because it describes a period certain annuity which does not provide lifetime income. Option D is incorrect because it only applies to a life-only annuity where payments stop upon the annuitant's death. Question 5. Which of the following is true regarding the taxation of annuity withdrawals in a non-qualified annuity? A. Withdrawals are taxed at capital gains rates regardless of how long the annuity has been in force. B. Withdrawals are taxed as ordinary income, with the earnings portion taxed first. C. Withdrawals are tax-free as long as the annuity has been in force for over 10 years. D. Withdrawals are taxed at a flat rate of 15% regardless of the amount or timing. Answer: B. Withdrawals are taxed as ordinary income, with the earnings portion taxed first. Explanation: in a non-qualified annuity, withdrawals are taxed as ordinary income. The portion of the withdrawal representing earnings, not the original premium, is taxed first. This is because the premium paid into the annuity is made with after-tax dollars, so it is not taxed again upon withdrawal. The earnings, however, are taxed at the annuitant's current income tax rate. Option is incorrect because annuity withdrawals are taxed as ordinary income, not at capital gains rates. Option C is incorrect because there is no time-based exemption for tax-free withdrawals in non-qualified annuities. All withdrawals are taxed on the earnings. Option D is incorrect because there is no flat rate for annuity withdrawals, they are taxed based on ordinary income tax rates. Question 6. Mr. Harris is 65 years old and has recently inherited an annuity from his aunt. What is the tax treatment of the inherited annuity for Mr. Harris? A. Mr. Harris will pay taxes only on the premiums paid into the annuity. B. Mr. Harris will pay taxes on the entire amount of the annuity, including the premiums and the earnings. C. Mr. Harris can withdraw the funds tax-free if he is over 591 years old. D. Mr. Harris will not have to pay any taxes on the annuity because it was inherited. Answer: B. Mr. Harris will pay taxes on the entire amount of the annuity, including the premiums and the earnings. Explanation: when an annuity is inherited, the beneficiary, Mr. Harris in this case, is subject to taxes on the entire value of the annuity, including both the premiums and the earnings. The IRS treats the earnings portion as taxable income. This taxation applies to both non-qualified and qualified annuities when they are inherited. Option is incorrect because the beneficiary is taxed on both the premium and the earnings. Option C is incorrect because being over 591 does not affect the taxation of inherited annuities. The tax treatment depends on the type of annuity, not the beneficiary's age. Option D is incorrect because inheritance does not automatically result in tax-free status for annuities. Question 7, scenario-based. Mr. Jackson is 68 years old and has a fixed annuity that guarantees him $3,000 a month for life. However, he would like to increase his monthly payments to account for inflation. Which of the following options would best suit his needs? A. A fixed annuity with a cost of living adjustment (COLA) rider. B. A variable annuity with a guaranteed minimum income benefit (GMIB). C. A life-only fixed annuity. D. A deferred annuity with an inflation rider. Answer: A. A fixed annuity with a cost of living adjustment (COLA) rider. Explanation: a fixed annuity with a cost of living adjustment (COLA) rider is specifically designed to address inflation. This rider adjusts the annuity payments annually based on a predetermined inflation rate, often tied to the consumer price index, ensuring that the payments increase over time to help maintain purchasing power. This option would be the best for Mr. Jackson's goal of keeping pace with inflation. Option B is incorrect because a variable annuity with a guaranteed minimum income benefit (GMIB) does not necessarily address inflation directly. The GMIB guarantees a minimum income, but it is not tied to inflation. Option C is incorrect because a life-only fixed annuity provides fixed income with no inflation protection. Option D is incorrect because a deferred annuity with an inflation rider typically does not begin payouts until a later date and is not suitable for someone like Mr. Jackson, who is already receiving monthly payments. Question 8. Which of the following is a disadvantage of purchasing a variable annuity? A. The annuitant is guaranteed a fixed rate of return. B. The annuitant can lose money in the accumulation phase if the market performs poorly. C. The annuitant's payments are fixed and cannot change over time. D. The annuitant is not allowed to choose how the funds are invested. Answer: B. The annuitant can lose money in the accumulation phase if the market performs poorly. Explanation: a variable annuity's value fluctuates based on the performance of the underlying investments, such as mutual funds or stock market indices. This means that during the accumulation phase, the annuitant faces the risk of losing money if the market performs poorly. The returns are not guaranteed and depend on market performance, which can be a disadvantage for risk-averse investors. Option is incorrect because a variable annuity does not guarantee a fixed rate of return. The returns depend on the performance of the chosen investment options. Option C is incorrect because the payment amounts from a variable annuity are not fixed and can vary depending on the performance of the underlying investments. Option D is incorrect because one of the benefits of a variable annuity is that the annuitant can choose how the funds are invested, typically across various investment options. Question 9. Which of the following best describes the suitability requirement for annuity sales in Nevada? A. Annuities must be sold to clients only after confirming their age and income level. B. The seller must ensure the annuity fits the client's financial needs, risk tolerance, and investment objectives. C. Annuities can be sold to any client regardless of their financial situation as long as they are willing to buy. D. Annuity sales require the client to sign a waiver indicating they are aware of all risks. Answer: B. The seller must ensure the annuity fits the client's financial needs, risk tolerance, and investment objectives. Explanation: Nevada's suitability requirements for annuity sales mandate that the product being sold must align with the client's financial situation, risk tolerance, and investment goals. The seller must perform due diligence to ensure that the annuity is appropriate for the client, ensuring the best interests of the client are met. This is a part of the state's regulations to prevent unsuitable sales and protect consumers. Option is incorrect because age and income alone are insufficient to determine suitability. A full analysis of the client's financial situation is needed. Option C is incorrect because annuity sales should not be made to clients who do not have a genuine need for the product. Option D is incorrect because simply having the client sign a waiver does not fulfill the suitability requirements, so the annuity must be appropriate based on their financial needs. Question 10. Which of the following statements regarding tax-deferred growth in annuities is correct? A. The annuity owner must pay taxes on the interest earned every year, regardless of whether they withdraw funds. B. Taxes are paid only on the earnings when they are withdrawn from the annuity. C. Taxes are paid immediately when the annuity is purchased. D. Tax-deferred growth applies only to qualified annuities. Answer: B. Taxes are paid only on the earnings when they are withdrawn from the annuity. Explanation: annuities are structured to provide tax-deferred growth, meaning the earnings, interest, or investment gains are not taxed until they are withdrawn. The principal initial investment is made with after-tax dollars, so it is not taxed again upon withdrawal. This tax deferral is a significant benefit of annuities, as it allows the investment to grow without the immediate tax burden, providing more time for compound growth. Option A is incorrect because taxes are not due on the earnings until they are withdrawn, so the annuity owner does not need to pay taxes on the interest annually. Option C is incorrect because taxes are not paid immediately when the annuity is purchased, they are deferred until withdrawals are made. Option D is incorrect because tax-deferred growth applies to both qualified and non-qualified annuities. The key difference is that qualified annuities are funded with pre-tax dollars, while non-qualified annuities are funded with after-tax dollars, but both types of annuities benefit from tax deferral on earnings. Question 11. Which of the following is a common feature of an immediate annuity? A. It provides income payments beginning immediately after purchase. B. It accumulates interest on the principal before any payouts are made. C. It allows the annuitant to make withdrawals at any time without penalties. D. It is designed to provide income for a set number of years, regardless of the annuitant's age. Answer A. It provides income payments beginning immediately after purchase. Explanation: an immediate annuity starts providing income payments almost immediately after the contract is purchased, typically within 1 month. This is one of the primary features that differentiates it from a deferred annuity, which begins payments at a later date. Option B is incorrect because immediate annuities begin payouts immediately without a build-up phase where interest is accumulated. Option C is incorrect because immediate annuities have fixed payout terms and typically do not allow withdrawals without penalties. Option D is incorrect because while some annuities are for a fixed number of years, immediate annuities are generally designed to provide income for the lifetime of the annuitant or for a specified period starting immediately. Question 12. Scenario-based. Mr. Thompson is 72 years old and wants to ensure a steady income for the rest of his life. He is considering purchasing an annuity with a death benefit for his children in case he passes away early. Which of the following annuity options would best suit Mr. Thompson's needs? A. A life-only annuity. B. A fixed-period annuity. C. A life with period certain annuity. D. A variable annuity with a death benefit rider. Answer: C. A life with period certain annuity. Explanation: a life with period certain annuity provides lifetime income to the annuitant, but if the annuitant dies before the end of a guarantee period, the 10 years, the remaining payments go to a beneficiary, such as Mr. Thompson's children. This option combines both lifetime income and a death benefit feature, addressing Mr. Thompson's concern about leaving something for his children if he passes away early. Option A is incorrect because a life-only annuity only provides income for the annuitant's lifetime with no death benefit for beneficiaries. Option B is incorrect because a fixed-period annuity provides payments for a specified period, but it does not offer a lifetime guarantee or a death benefit beyond the period. Option D is incorrect because while a variable annuity can have a death benefit rider, it does not guarantee fixed income for life as Mr. Thompson requires. Additionally, variable annuities are subject to market risk. Question 13. Which of the following statements is true regarding the free look period in annuity contracts? A. The free look period allows the annuitant to cancel the contract and receive a full refund, no questions asked. B. The free look period allows the annuitant to cancel the contract within 30 days and receive a full refund of the premiums paid, minus any withdrawals. C. The free look period lasts for the first 90 days of the contract and allows for a partial refund of premiums. D. The free look period applies only to fixed annuities and not to variable annuities. Answer: B. The free look period allows the annuitant to cancel the contract within 30 days and receive a full refund of the premiums paid, minus any withdrawals. Explanation: the free look period is a provision in annuity contracts that allows the annuitant a specified period, usually 10 to 30 days, to review the contract and cancel it for a full refund of premiums paid, minus any withdrawals. This gives the annuitant time to reconsider their decision without financial penalty. Option A is incorrect because while the free look period allows cancellation and a refund, it is not always no questions asked. It typically applies only if no withdrawals have been made. Option C is incorrect because the free look period is usually 10 to 30 days, not 90 days, and it does not provide partial refunds, only a full refund minus withdrawals. Option D is incorrect because the free look period applies to both fixed and variable annuities, providing the same cancellation rights to both types. Question 14. Which of the following is a key advantage of purchasing an annuity with a guaranteed minimum income benefit (GMIB)? A. It provides unlimited withdrawals without any penalties. B. It guarantees a minimum level of income regardless of the investment's performance. C. It allows for tax-free growth of the annuity's earnings. D. It provides a higher payout rate than a traditional fixed annuity. Answer: B. It guarantees a minimum level of income regardless of the investment's performance. Explanation: a guaranteed minimum income benefit (GMIB) ensures that the annuity will provide a minimum level of income even if the investments underlying the annuity perform poorly. The annuitant will receive at least the minimum income specified in the contract, which provides a safety net against market volatility. Option A is incorrect because a GMIB does not allow unlimited withdrawals without penalties. It still has limits and conditions. Option C is incorrect because while annuities do offer tax-deferred growth, a GMIB does not provide tax-free growth of earnings. Option D is incorrect because GMIBs are designed to ensure a minimum income, not to provide higher payout rates compared to fixed annuities. The payout rate may be adjusted based on the annuity's performance. Question 15. Which of the following is typically true regarding the distribution options for a fixed annuity? A. Fixed annuities provide a lump sum distribution option only. B. Fixed annuities allow for flexible withdrawals without penalty. C. Fixed annuities provide a variety of distribution options, including lump sum, periodic payments, or lifetime income. D. Fixed annuities do not allow any form of distribution before the annuitant reaches the age of 70. Answer: C. Fixed annuities provide a variety of distribution options, including lump sum, periodic payments, or lifetime income. Explanation: fixed annuities offer various distribution options for the annuitant depending on the terms of the contract. These options include receiving a lump sum, periodic payments, or lifetime income. The choice of distribution method allows the annuitant to customize their annuity to meet their financial needs. Option A is incorrect because fixed annuities offer more than just a lump sum distribution, and they also allow periodic payments or lifetime income. Option B is incorrect because fixed annuities typically do not offer flexible withdrawals without penalties, as they are designed to provide a predictable stream of income. Option D is incorrect because fixed annuities allow for distributions before age 70, but the method and timing of distributions depend on the terms of the contract. Question 16. Which of the following annuity types provides the annuitant with the opportunity to participate in market gains while also protecting against market losses? A. Fixed annuity. B. Variable annuity. C. Equity indexed annuity. D. Immediate annuity. Answer: C. Equity indexed annuity. Explanation: an equity indexed annuity IA allows the annuitant to earn returns based on the performance of a stock market index, e.g., the S&P 500, while offering a level of protection against market losses. Typically, the annuity has a minimum guaranteed return, ensuring that the annuitant does not lose principal due to market downturns. Option A is incorrect because a fixed annuity provides a guaranteed fixed interest rate and does not participate in market gains. Option B is incorrect because a variable annuity allows the annuitant to invest in sub-accounts, usually mutual funds, and directly participate in market gains or losses, but it does not provide protection against losses. Option D is incorrect because an immediate annuity provides a set income stream based on the contract terms but does not allow for participation in market gains. Question 17. What is a primary benefit of purchasing a fixed annuity? A. The income payments fluctuate based on the market performance. B. The principal is guaranteed to grow at a fixed rate. C. The annuitant can withdraw funds without penalties at any time. D. The annuitant can invest in a wide range of asset classes. Answer: B. The principal is guaranteed to grow at a fixed rate. Explanation: a fixed annuity provides a guaranteed return on the principal investment. The insurance company offers a fixed interest rate for the term of the contract, which guarantees predictable growth and income, offering security to the annuitant. Option A is incorrect because the income payments from a fixed annuity do not fluctuate based on market performance. Option C is incorrect because fixed annuities typically have restrictions on withdrawals and may charge penalties for early withdrawals. Option D is incorrect because fixed annuities generally do not offer a wide range of asset classes for investment. The insurance company controls the investment options. Question 18. Scenario based. Mr. Roberts is considering purchasing an annuity for his retirement, but he wants the option to choose different investment strategies based on market performance. Which type of annuity would be most suitable for Mr. Roberts? A. Fixed annuity. B. Variable annuity. C. Immediate annuity. D. Equity indexed annuity. Answer: B. Variable annuity. Explanation: a variable annuity allows the annuitant to invest in different sub-accounts such as stocks, bonds, and mutual funds, which provides the opportunity to adjust investments based on market performance. This gives Mr. Roberts the flexibility to choose from various investment strategies. Option A is incorrect because a fixed annuity offers a guaranteed interest rate and does not allow for investment choices. Option C is incorrect because an immediate annuity starts income payments immediately and it typically does not offer flexibility in investment strategies. Option D is incorrect because an equity indexed annuity provides limited exposure to market gains and typically has a cap on the returns, unlike a variable annuity. Question 19. Which of the following is a disadvantage of a variable annuity? A. It offers guaranteed returns. B. It allows the annuitant to invest in a wide range of asset classes. C. The annuitant is exposed to market risk and may lose money. D. It has no administrative fees. Answer: C. The annuitant is exposed to market risk and may lose money. Explanation: variable annuities are subject to market fluctuations, meaning that the annuitant's returns depend on the performance of the investments chosen. While there is the potential for high returns, there is also the risk of losing money if the investments underperform. Option is incorrect because variable annuities do not offer guaranteed returns, and they depend on market performance. Option B is correct, but does not describe a disadvantage. It highlights the flexibility of variable annuities, which can be an advantage for some investors. Option D is incorrect because variable annuities typically have administrative fees, mortality and expense fees, and other charges. Question 20. Which of the following would typically not be covered under the terms of a life insurance policy with an accidental death rider? A. Death from a heart attack. B. Death from a car accident. C. Death from falling off a ladder. D. Death from a workplace accident. Answer: A. Death from a heart attack. Explanation: An accidental death rider typically only covers death resulting from accidents such as car accidents, falls, or workplace accidents. Death caused by natural causes like a heart attack is not covered under this rider. Option B is incorrect because a car accident would be covered under an accidental death rider. Option C is incorrect because falling off a ladder would typically be considered an accidental death and would be covered by the rider. Option D is incorrect because workplace accidents are usually covered by the accidental death rider. Question 21. What is the primary purpose of a long-term care rider attached to a life insurance policy? A. To provide a death benefit upon the policyholder's death. B. To provide coverage for extended healthcare services, such as nursing home care. C. To reduce the policyholder's premiums for the first 5 years. D. To offer cash value accumulation for the policyholder. Answer: B. To provide coverage for extended healthcare services such as nursing home care. Explanation: a long-term care rider attached to a life insurance policy helps cover the costs of long-term care services such as nursing home care, home health care, and assisted living. This rider is often added to provide policyholders with additional protection against the high cost of long-term care. Option is incorrect because the death benefit is a primary feature of the life insurance policy itself, not the long-term care rider. Option C is incorrect because a long-term care rider does not generally reduce premiums for the first 5 years. It adds coverage for long-term care. Option D is incorrect because the rider is for healthcare services, not cash value accumulation. Question 22. Which of the following is a characteristic of a return of premium life insurance policy? A. The policyholder receives the full premium amount back if they outlive the policy term. B. The death benefit is equal to the premiums paid. C. The policyholder can borrow against the premiums. D. The policyholder receives a fixed amount in cash value regardless of the death benefit. Answer A. The policyholder receives the full premium amount back if they outlive the policy term. Explanation: a return of premium life insurance policy refunds the premiums paid by the policyholder if they outlive the term of the policy. This type of policy is typically more expensive than a standard term life insurance policy because of this added benefit. Option B is incorrect because the death benefit is generally higher than the premiums paid. Option C is incorrect because the return of premium policy does not allow borrowing against premiums. That is more typical of permanent life insurance policies. Option D is incorrect because cash value is not guaranteed with return of premium policies. Question 23. Which of the following is a benefit of a 1035 exchange in life insurance or annuities? A. The exchange allows the policyholder to switch to a higher premium policy without tax consequences. B. The exchange allows the policyholder to avoid paying taxes on gains when moving funds from one policy to another. C. The exchange increases the cash value of the policy. D. The exchange guarantees a higher interest rate on the new policy. Answer: B. The exchange allows the policyholder to avoid paying taxes on gains when moving funds from one policy to another. Explanation: a 1035 exchange allows policyholders to transfer the cash value of an existing life insurance policy or annuity to a new policy or annuity without triggering taxes on the gains. This can be a tax-efficient way to switch policies or annuity types. Option A is incorrect because the exchange does not affect the premium but rather the policy or annuity type. Option C is incorrect because the 1035 exchange does not directly increase the cash value, although the policyholder may have different terms or features in the new policy. Option D is incorrect because the exchange does not guarantee a higher interest rate. Question 24. Which of the following best describes the waiver of premium rider in life insurance? A. It waives premiums if the policyholder becomes permanently disabled. B. It waives premiums for the first 5 years of the policy. C. It guarantees the policyholder's premium will be reduced every 5 years. D. It provides the policyholder with a death benefit even if the premiums are not paid. Answer A. It waives premiums if the policyholder becomes permanently disabled. Explanation: a waiver of premium rider allows the policyholder to stop paying premiums if they become permanently disabled without the policy lapsing. The policy remains in force even though premiums are not being paid. Option B is incorrect because the waiver of premium does not automatically apply to the first 5 years of the policy. It applies in the event of a permanent disability, regardless of the policy's age. Option C is incorrect because the waiver of premium rider does not guarantee a reduction in premiums every 5 years. It specifically waives the premium payments if the policyholder becomes disabled. Option D is incorrect because the waiver of premium rider does not provide a death benefit if premiums are not paid. It allows the policy to remain in force by waiving future premium payments when the policyholder is unable to work due to a disability. Question 25. Which of the following is a characteristic of term life insurance? A. It builds cash value over time. B. It provides coverage for a specified period of time. C. It is usually more expensive than whole life insurance. D. It guarantees a death benefit to the policyholder's beneficiaries regardless of the health status. Answer: B. It provides coverage for a specified period of time. Explanation: term life insurance provides coverage for a specified period, typically ranging from 10 to 30 years. If the policyholder passes away during this period, their beneficiaries receive the death benefit. Term policies do not accumulate cash value and they do not last indefinitely. Option is incorrect because term life insurance does not build cash value. The feature is typically associated with whole or universal life insurance. Option C is incorrect because term life insurance is generally less expensive than whole life insurance because it does not accumulate cash value and has a set coverage period. Option D is incorrect because term life insurance only provides a death benefit if the policyholder passes away during the term. It does not guarantee coverage beyond the specified period. Question 26. In which of the following scenarios would a policyholder most likely consider purchasing a life insurance policy with a child rider? A. To provide additional coverage for a child in the event of an accident. B. To accumulate cash value for a child's future education. C. To increase the policy's death benefit payout to the family. D. To provide a death benefit in case of the death of a child. Answer: D. To provide a death benefit in case of the death of a child. Explanation: a child rider is an optional add-on to a life insurance policy that provides a death benefit if a covered child passes away. This rider is generally inexpensive and can offer financial protection for the family in case of an unfortunate event. Option A is incorrect because a child rider does not provide coverage specifically for accidents but rather for the death of the child. Option B is incorrect because the child rider does not build cash value for a child's future needs like education. It is only intended to provide a death benefit in case of a child's death. Option C is incorrect because the primary purpose of a child rider is not to increase the family's death benefit but to offer coverage in the unfortunate event of a child's death. Question 27. Which of the following is true regarding universal life insurance? A. It has fixed premiums and guaranteed death benefits. B. It offers flexible premiums and death benefits that can be adjusted. C. It is designed primarily to provide short-term coverage for specific financial obligations. D. It does not accumulate cash value. Answer: B. It offers flexible premiums and death benefits that can be adjusted. Explanation: universal life insurance is a type of permanent life insurance that provides flexibility in terms of premiums and death benefits. Policyholders can adjust their premiums and death benefits within certain limits, allowing for more control over their insurance coverage. Option A is incorrect because universal life insurance does not have fixed premiums. It allows for flexibility in premium payments. Option C is incorrect because universal life insurance is designed for long-term coverage, not just short-term financial obligations. Option D is incorrect because universal life insurance does accumulate cash value, which grows over time and can be used to cover premiums or borrowed against. Question 28. Scenario-based. Alicia wants life insurance that provides her with lifelong coverage, allows her to adjust premiums as her financial situation changes, and also offers the opportunity to accumulate cash value. Which type of life insurance would be most suitable for Alicia? A. Term life insurance. B. Whole life insurance. C. Universal life insurance. D. Variable life insurance. Answer: C. Universal life insurance. Explanation: universal life insurance offers flexible premiums and adjustable death benefits. It also accumulates cash value, which can be used to pay premiums or borrowed against. This makes it a good option for someone like Alicia who wants long-term coverage, flexibility, and a cash value component. Option A is incorrect because term life insurance only provides coverage for a specified period and does not offer cash value accumulation or flexibility in premiums. Option B is incorrect because whole life insurance offers lifelong coverage and a fixed premium but does not provide as much flexibility as universal life insurance. Option D is incorrect because variable life insurance allows the policyholder to invest in sub-accounts but does not focus as much on flexible premiums and death benefits as universal life insurance. Question 29. Which of the following is the main purpose of an accelerated death benefit rider in a life insurance policy? A. To provide an additional payout if the policyholder becomes disabled. B. To allow the policyholder to access a portion of the death benefit if diagnosed with a terminal illness. C. To provide income replacement for the policyholder's family in the event of death. D. To increase the death benefit after the policyholder reaches a certain age. Answer: B. To allow the policyholder to access a portion of the death benefit if diagnosed with a terminal illness. Explanation: an accelerated death benefit rider allows a policyholder to access a portion of their life insurance death benefit while still alive, typically if they are diagnosed with a terminal illness. This can help cover medical expenses or other costs associated with their illness. Option A is incorrect because the accelerated death benefit rider does not provide benefits for disability but rather for terminal illness. Option C is incorrect because the rider is specifically for terminal illness and does not provide ongoing income replacement. Option D is incorrect because the accelerated death benefit does not increase the death benefit but allows access to part of it before death. Question 30. Which of the following best describes the concept of underwriting in life insurance? A. The process of reviewing claims after a policyholder's death. B. The process of issuing a life insurance policy without considering the applicant's health. C. The process of assessing the applicant's risk and determining the premium rate. D. The process of setting the death benefit amount based on the applicant's income. Answer: C. The process of assessing the applicant's risk and determining the premium rate. Explanation: underwriting in life insurance refers to the process where the insurer assesses the applicant's risk level based on factors such as health, age, occupation, and lifestyle. This information is used to determine the premium rate and whether the applicant is eligible for coverage. Option is incorrect because underwriting occurs before issuing the policy, not after a claim is made. Option B is incorrect because underwriting does take the applicant's health and other factors into account when issuing a policy. Option D is incorrect because the death benefit amount is typically determined by the policyholder's preferences or financial needs, not solely based on income.